Well, how do I start this video? So, the stock market, I don't even know what to say anymore, people. It's crazy. It's getting crazier. I would call it stupid crazy right now. Every single week, something new seems to be happening in the past couple months. FOMC meeting just this past week, maybe 2 days ago, they decided they're going to hike benchmark rates. They decided to go with 75 basis points. Some people thought they'd go as high as 100. They didn't do that. That's good. The market essentially would have just melted our faces off if they did. But I'm happy that they didn't do that. Although, there is rampant inflation and they're trying to cool things down. So understandable what they're trying to do. And at the same time, it's pretty scary because what's going on with inflation, and they have to battle this. And that's how they do it, by essentially battling it with interest rate hikes. And at this point, honestly, Jerome Powell he's Liam Neeson. His daughter's been taken. You don't want to mess with him. Let's try to unwrap what's going on lately. At the end of the day, if you watch this channel, and if you're new here, welcome. My name's Robbie. I make videos on ETF investing, stock market investing, what's going on in the market, and I am always optimistic. That's something you should always take away from my videos. Let's start. Let's go with the federal funds rate, and let's look back and what it's looked like over the past since the 1970s. We got a tweet here from Jerome Powell, and he says, breaking, the Federal Reserve hikes rates by 75 basis points, lifting the Fed funds target rate to 3.25%, topping the latest tightening cycle peak. Let's put this into the context. Let's go back. Let's see what's going on back in the 70s. Okay. Rampant inflation back in the 70s. Today we have rampant inflation right now, but the 70s was a crazy time. So we had a benchmark rate, Fed target rate of over 12.5% back in 1974, and they lowered it. Essentially, they kind of did a fake out, right? They I guess you would say they were being big wusses. And they decided that they were going to lower rates, and then inflation kept going, burning hot, and they had to just continue to increase it up to over 17.5%. Can you imagine how high the rate hike was to get to that point? And here we are over here at 3.25%. Now, as you can see along the way, from up here, this giant peak, I hope we never have to get back there again, but from that giant peak, all the way down to where we are down here in, let's say, 2008 period, that's when rates really got cut to essentially zero, let's face it. And they were cut there from about 5.25% in, let's say, when the real estate market was getting hot and Greenspan, Bernanke, they decided to increase the rates, I think, to start cooling things down. Essentially, everything broke. The economy broke, not necessarily because they increased rates, just because of what was going on, and it was just a crazy time. And since then, we've had to keep rates so low because essentially, every time they start doing something, it seems like things go overboard, right? And so what's happening here is finally in 2016, Fed starts to increase rates. Oh no, COVID happens. That's not good. We're going to basically go back down to essentially zero for the Fed target rate. And what happens? Well, we pump money into the economy. People are hurting. So I understand why the Fed definitely did this. However, you had a bunch of stimulus checks, a lot of money going into the economy. And honestly, it was just rampant speculation in the stock market. People were getting checks. They're throwing it into the market. They're throwing it into cryptocurrencies. There's a lot of money flowing around. And it's just too much. It's too much. And suddenly we have crazy inflation right now. And what do? Well, the Fed has to increase rates very rapidly, I might add, because look, these past times, it's not happened. The slope of this line is way higher, or way more slopey. Is that a word? Slopey? The slopiness of this line is way more slopey. There's more slopiness than these other time periods. Next, very interesting, I want to talk about right here. Markets in Mayhem tweeted out, Fed funds futures are now pricing in a terminal rate of 4.5% to 4.75% during the first half of 2023. Okay, so this was tweeted before the FOMC announced that they're going to increase rates by 0.75%. Okay, so what's going on in this basically tweet is what he's saying is the futures of the federal funds rate. So what is the futures market essentially? What do they think? What are they projecting that is going to be the future Fed funds rate? And of course, the futures market, they don't know. Like, this is essentially, in a way, a guess. But at least this is what people think, and it's a good gauge to show us what people are now thinking and what the market's thinking. And so what I wanted to do is I wanted to go down to this little black line. This is basically saying, okay, what it was before the market, before the FOMC committee meeting announcement, and then what was it after. And I'm looking out just 1 year, okay? So essentially, the probabilities now are that over here, this is 4.25% to 4.50%. Now, this is next year, September of 2023. 29.9% chance that the Fed target rate is going to be 4.25 to 4.50%. Okay. Now, I ran this. I went to the website. He got CME Fed Watch tool. And now I looked at it today after the meeting. So what happened? Okay. So basically, if we go back, we have this 4.25, the 425 to 450, there's 29.9%. Okay, what is 425 to 450 now? It's 27.6%. So there is a lower probability now of having 4.25 to 4.50%. What is it? It's a now higher probability that it's 450 basis points or 4.5% to 4.75%, as you can see here. And over here, so before it was 19.9%. So we're getting a much higher probability of higher rates going forward. That's what the market is thinking, essentially. That's what we're looking at here. Why do we care about interest rates? What does it matter? Who cares, right? Who cares what interest rates are? Wrong. Very, very important what interest rates are. So interest rates in terms of stocks, in terms of the economy, Warren Buffett has a saying. He says that interest rates are like gravity for stocks. So why? Okay, let's say I want to go build a factory and I need capital, okay? I can go maybe to a lender and I can get money and take debt on, and I can basically pay back that debt to the lender, and I have to pay an interest rate. Okay, well, let's say my interest rate a year ago was 4%, 3%. And now let's say I go back to that same lender today, and instead of, let's say, 3 or 4%, now it's like 7, 8%, right? And suddenly it's like twice as much money in terms of the interest rate and the debt that I'm gonna have to pay to build this factory. And that happens across the entire economy. And so this one instance of just building a factory could be anything. It could be expanding operations for something. You could have a certain project that you want to go ahead and a company wants to execute. All these things happen to be connected likely to interest rates. However, sometimes things get out of control. And as you can see, that is what's happened now. So what do? Well, the Fed has to go and they have to increase interest rates to try to stop the inflationary environment. That's what's going on here. And so when we look back at this markets and mayhem thing, why does this matter? Well, because now people are starting to think. Before, they thought that there was only, let's say, 29% chance of a 425 to 450 basis points in the Fed funds rate in, let's say, a year from today. And now suddenly they're thinking that it's going to be there. It's less likely to be that, and it's way more likely that it's going to be 450 to 475. So they think interest rates are going to be higher. And so what's that mean? Well, it hurts probably sentiment. It can hurt the ability of people or let's say business managers to want to invest in projects, because that little 25 basis points to 50 basis points may be the break even for them to even do a project, right? So this like reverberates throughout the economy. And this is one of the reasons why the Fed does this, because they're trying to stop and slow down the inflationary environment and essentially economic growth. Now, okay, this is AAII Bearish Sentiment versus the S&P 500, 1987 to present. Now, AAII is the American Association of Individual Investors Bearish Sentiment. This does is it's gone back over time since 1987, and we can see the sentiment of these people that are surveyed. Now, I got this tweet from Bespoke, and basically they're saying the reading crossed over 60% this week for only the 5th time in the history since 1987. And guess when this last happened? Was pretty much at the depths of the Great Recession. However, there might be some positivity that we can bring out of this, because let's look. And actually, wait, before we do look at that, I just want to show you here that this is the sentiment, and this is the bearish sentiment, and it is at this above this red line. The last time I was here was back here in the depths of the Great Recession, right? Okay, so let's go back to March of 1999, one of the other times when this was also hit. And look at this. It hit it here. It hit 61 on August 30th of 1990, and then it hit 67 on October 18th of 1990. So over a few month period, this thing gets down. Let's say the bearish sentiment gets so high, and then what does that signal? It ends up being essentially the bottom, right? So that actually was a good thing. So this sentiment indicator can actually potentially signal when the economy or when the market's going to start actually doing better. So when people are in the height of their bearishness, weirdly enough, that sometimes is the end of all the pain. We go here, March of 2008 till September 2009. So it hits 60 on October 9th of 2008. Now, at the bottom of that Great Recession, the market was 3.5, so March 5th of 2009. And that's when basically the Great Recession hit the bottom, right? It bottoms out and it goes up from there and it never looks back. And sentiment at 70.3. So if we look back, 70.3, that's when it got to this height, like the highest it's ever been. So it's off the charts, and that off the chart reading ends up being the best time to actually invest. So right now, we're looking at a potentially good time to invest if that happens again. See, we're ending on a positive note. I told you, this is a positive YouTube channel. Okay, so far, that's a good indicator, potentially good indicator, right? So let's look at another potentially good indicator. So here we have a chart tweeted out from Isabel Net. It says bull market. So far, the secular bull market remains intact. Okay, so what are we looking at here? This red line is the 200-week moving average. So 200 weeks, that's like 4 years, I think. So it's the moving average of the S&P 500 over 4 years. And as you can see, we crossed this back in 2011, and at that time, we entered what is being considered by Isabelnet as the secular bull market. We have never gone under this point except for maybe a few day period during the during the pandemic. But of course, that was kind of like a one-off thing. We bounced right out of that thing. We've been above this ever since. And so he's saying, or she's saying, that this is a secular bull market. And then if you look at the blue line, that's actually the 40-week moving average. So call it 9 months. And we are actually we hit that and we're rejected off of that. And now we are coming back down to we'll see where we end up. But if we get down to the 36.36 to 35.86, we're going to be near this 200-week moving average. So according to this, we're still in a secular bull market. This is a good sign, in my opinion. We're still above this 200-week moving average. We are, of course, under the 40-week moving average. We were rejected off of it. But let's see what happens. Maybe we'll actually get a bounce over here at the 200-week, and we won't fall and break down through that moving average, and the secular bull market will continue. Now, maybe it won't. Maybe we will break down through that moving average, and it could be the end of the secular bull market. Of course, I hope that doesn't happen. It could, of course, happen. But this is just a positive sign. We're still in this thing. We have not lost out on the secular bull market yet. Things are still good compared to the past, and we'll see what happens in the future. But at this point in time, I'll tell you one thing. I'm still buying stocks. That's all we have for this video. But I actually should say I'm buying stocks and ETFs, not just stocks. But that's all we have for the video. Thanks so much for watching. I hope you liked it. Hit the like button if you did. Subscribe to see future videos like this. I would really appreciate that. And if you want to watch another video, please watch one on the end screen right now. Thanks everyone so much for watching. I do want to remind you, I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence.